January 1st, 2026. Silver collapses, $70. Headlines explode. Silver crashes. Bubble pops. China shocks markets. And right now, millions of people are being tricked into making the worst possible decision at the exact wrong moment. Because what happened on January 1st was not a bearish event. It was not a failure. It was not the end of the silver story. It was the moment the illusion finally broke. And most people completely missed it. Let me be very clear. This was not a normal sell-off. This was not a market reacting rationally to news. This was a forced paper liquidation colliding with a physical panic. And those two realities are now moving in opposite directions. While paper silver collapsed to 70, physical silver did the exact opposite. Premiums exploded. Buyers panicked. Metal vanished. That is not a crash. That is a divorce. And the reason for that divorce has a name: China. On January 1st, 2026, China officially classified silver as a strategic material, not metaphorically, not rhetorically, legally, structurally, permanently. Silver now sits in the same category as rare earth elements, missiles, energy metals, critical war materials, and history tells us exactly what happens next. In 2010, China did this with rare earths. Overnight, exports were restricted, prices exploded, Western supply chains collapsed, entire industries froze. The West panicked, China gained leverage, and that leverage has never been surrendered. Silver is now on the same path, only this time the stakes are higher. Because silver is not a niche input, it is embedded in everything. EVs, solar, electronics, AI, defense systems, telecommunications, space. China didn't regulate silver, China weaponized it. As of January 1st, only 44 state-aligned companies are allowed to export silver. 44. Out of an entire nation, every shipment must be approved, tracked, licensed, rationed. This gives Beijing something unprecedented: a dashboard, a throttle, a choke point. They can decide who gets silver, how much, and when. That is not a market, that is control. And the paper market responded exactly how weak systems always respond. It panicked. Leverage unwound. Stops were hit. Speculators liquidated. Algorithms sold. The paper price crashed 5% in hours. But here's what didn't crash: reality. Because while the COMEX price said 70, the physical market said something very different. Indian buyers were paying $8 to $10 over spot. Chinese firms were offering $80 for immediate delivery. Industrial buyers did not slow down, they accelerated. This created a 14% premium overnight. Let me repeat that. A 14% premium in a market that supposedly crashed. That is not bearish. That is desperation. And desperation only shows up when supply is threatened. These are not Reddit traders. These are not momentum chasers. These are manufacturers, infrastructure builders, strategic buyers, people who cannot turn off factories because price pulled back 5%. They are doing the math: pay 80 today or pay 150 later, or shut down production entirely. That is not speculation. That is survival. This is what smart money actually looks like: not buying paper dips, buying physical metal at any price. And when you see physical premiums explode while paper collapses, that tells you exactly which market is lying. The paper market is emotional, leveraged, reactive. The physical market is calm, intentional, and ruthless. This is why $70 is not a breakdown. It is a retest, a final shakeout, a psychological attack, a wealth transfer. Weak hands sell in panic. Strong hands buy in silence. And here's the key detail most people are missing. Those physical buyers paying $80, they are building a floor, a real floor, backed by metal, not sentiment. Paper markets can print infinite contracts. Physical markets cannot print atoms. This is why the divergence matters more than the price. Now let's talk about Elon Musk, because this is where the story changes from theory to confirmation. When Elon Musk publicly says, "This is not good, silver is needed in many industrial processes," that is not a tweet, that is a warning. Musk does not talk unless he has to, and he does not exaggerate. Tesla, SpaceX, Starlink, AI data centers, robotics. Every one of his companies depends on silver at scale. When the world's most advanced industrialist acknowledges a silver shortage, that's not bullish sentiment, that's operational concern. And that concern is now shared across the tech sector. Because China's move didn't just affect traders, it hit procurement departments, supply chain managers, government planners, defense contractors. This is where panic actually begins, not on Twitter, in boardrooms. Now zoom out. This is happening against a collapsing dollar. The US dollar lost nearly 10% in 2025. Gold surged 60%, silver doubled. Capital is fleeing fiat, and China knows it. By restricting silver, China accomplishes three things at once. First, it protects its own green tech and AI industries. Second, it cripples Western manufacturing leverage. Third, it accelerates de-dollarization. Silver is not just an industrial metal. It is a monetary weapon. And Beijing just picked it up. This is why January 1st was not bearish. It was irreversible. Once a nation classifies a material as strategic, it never goes back to being free. There's no rollback, no easing, no normalization. This is a one-way door. Western supply replacement will take years. New mines take a decade. Recycling can't scale fast enough, and byproduct supply is fixed. Meanwhile, demand is locked in. Solar installations, EV mandates, AI expansion, defense spending. Silver demand is price inelastic. Industries will not stop because silver is expensive. They will stop because it is unavailable. And that is when price becomes meaningless. This is why selling at $70 is capitulation. You are handing metal to the very buyers who understand what's coming. At a discount, $70 is not a failure. It is a gift created by paper mechanics, disconnected from physical truth. The paper market screamed, the physical market whispered. And the whisper matters more because paper sets headlines, physical sets history. In part 2, we're going to talk about what happens next, why $70 is likely the lowest price you'll see again, why the death of paper price discovery has already begun, and how this sets up the most violent silver repricing of the modern era. Because the fuse is lit, and this time, it's not speculation driving the move, it's necessity. Now let's talk about what happens next. Because once a market reaches this stage, it does not heal, it does not normalize, and it does not return to the old rules. What you're watching right now is the death of paper price discovery and the birth of physical price discovery. For decades, silver was priced by leverage, futures contracts, options, swaps, derivatives, thousands of paper ounces traded for every physical ounce in existence. That system only works under one condition, that no one asks for delivery. China just changed that condition. When Beijing restricts exports, when physical flows tighten, when industrial buyers front-run scarcity, delivery matters again, and delivery is where the paper market breaks. Because the paper market does not have silver, it has promises. This is why the crash to $70 was violent, not because silver is weak, but because the paper system is fragile. Leverage had to be flushed. Margins had to be met. Risk desks had to de-risk. That flush is now mostly complete. And here's what matters next. Watch the rebound levels. 70 was the retest. 75 is the first reclaim. 80 is the psychological battlefield. Once 80 is reclaimed, the entire narrative collapses. Because 80 is no longer speculative, it becomes confirmation. At that point, industrial buyers stop waiting. They accelerate. Funds re-enter. Retail follows. And the paper shorts realize something terrifying. There is no metal behind their position. This is where short covering turns violent. Because when you are short paper and physical disappears, there's only one exit, buying. And that buying feeds on itself. This is how parabolic moves are born. Not from hype, from imbalance. Now let's address the skeptics. They will say this happened before. They will mention 2011. They will talk about margin hikes. They will talk about bubbles. They are wrong. In 2011, there was no structural deficit. In 2011, China was exporting freely. In 2011, inventories were full. In 2011, industrial demand was optional. Today, none of that is true. We are in the 5th consecutive year of supply deficit. Above-ground stocks are drained. COMEX inventories are a fraction of what they were. LBMA vaults are strained, and silver is no longer optional. It is embedded in every future-facing technology. This is why technical indicators no longer matter. RSI can scream, charts can wobble, patterns can fail, because physics doesn't care about charts. Silver conducts electricity better than anything else. That fact cannot be hedged. This is also why mainstream media will get it wrong. They always do at inflection points. They will call this volatility. They will call this risk. They will call this uncertainty. But what they won't say is this. Access is replacing price. When markets reach this phase, you don't ask how much it costs. You ask if you can get it at all. This is what happened with energy, with chips, with rare earths, and now with silver. China understands this better than anyone, which is why they moved first, quietly, decisively, legally. Western governments are reacting late, adding silver to critical minerals lists, issuing warnings, talking about supply chains. But talk does not create metal. This is why $70 will not be remembered as a crash. It will be remembered as the last easy price. From here, the path is not smooth. There will be volatility. There will be smashes. There will be headlines designed to scare you out. That is how this always ends. But the math does not change. Demand exceeds supply. Exports are restricted. Inventories are finite. That equation only resolves one way, higher. 80 will fall. 90 will not hold. 100 becomes inevitable, not because people want silver, but because they need it. And when necessity enters the market, price becomes secondary. This is why 2026 is the year silver runs. not gradually, violently. The fuse was lit on January 1st. The crash was the spark. The repricing is next. So if you are holding physical silver, understand what you own. You are not holding a trade. You are holding leverage over a broken system. And if you are not holding, understand the window is closing. Not slowly, quickly. Because once availability disappears, no price will bring it back. This is not fear. This is clarity. The paper era is ending. The physical era has begun. And silver is no longer just a metal. It is a weapon, a signal, and a line in the sand. History will not remember the headlines. It will remember who understood what was happening while it was happening.